Welcome back to another episode of Palisade Radio. I'm your host, Karim Mamutlu. On today's show, we have Mike Beck, who is the Managing Director of Region Advisors. How are you today, Mike?
I'm fine, thank you for inviting me.
We are currently at the 2019 Palisade Hard Asset Conference here in Jekyll Island. So I wanted to bring Mike onto the show and get an update from when he spoke in 2017 and regarding electric vehicles. The adoption rate for electric vehicles today, is that surprising you since 2017?
No, I think it's pretty much on track. In 2017, electric vehicles were about 1% of the market. Today it's 3%, and I think it's a little bit like smartphones. We're at the sort of early adoptions stage, and we will see parabolic growth as we move, but over the next couple of years. But the real growth, the so-called S adoption curve, where like in smartphones, you went from 10% of the population having smartphones to 18 months later, everybody having them, will occur when electric vehicles achieve cost parity with ICEs, internal combustion engines. And that day is not too far off. If you look at some of the projections, it's really driven by declining battery prices. So battery prices have gone from $1,200 a kilowatt hour in 2010 to last year sub 200, on their way to $100. Most analysts reckon that when you hit $100 a kilowatt hour, it's game over. At that point, it will be cheaper, less expensive for the consumer to purchase and operate an electric vehicle than an ICE equivalent. And at that point, no rational consumer, unless they have some special interest or fascination with internal combustion engines, would buy and pay more for what is obviously an obsolete technology. So the question is, when do we hit the crossover points? Well, it varies by jurisdiction. So the first is likely to be diesels in Europe, and that crossover point is expected to be somewhere between 2021 and 2022, so that's 2 to 3 years away, not that long. Mm-hmm. And shortly thereafter, the next year, the same will hold true for EU petrol vehicles. And then where petroleum prices are lower because of lower taxation, that is the US and China, it'll be sort of a 2023, 2024 event. And at that point, you, as a consumer, when they go to purchase their next vehicle, the default decision in most cases will be electric because it's cheaper, better, and cooler. And so you'll see a real sort of hockey stick upswing in adoption. And by 2025, I would be surprised if 15 to 20% of all new passenger vehicle purchases are not electric. And it may surprise us on the upside, because when these things turn, they tend to turn more quickly than anybody anticipates.
Yeah. Certain Chinese battery makers are now heading towards 811 battery chemistries with a focus more on nickel. If this continues, do you think this will fundamentally change the nickel market over the next couple of years?
I don't think it'll fundamentally change the dynamic, which is we're heading toward a global shortage of nickel units. What it will do is it will just accelerate the crunch. The crunch in terms of shortage of nickel units is now anticipated to be 2022, 2023, and to the extent either the EV adoption rate accelerates beyond the consensus estimate, or there's a massive swing from lower nickel chemistries like 632 or 532 to 811. It will accelerate and bring forward the crunch in terms of nickel supply. So Nickel is actually our favorite battery metal for the next 2 to 3 years out, because there's a structural deficit baked into the supply chain. Since nickel prices collapsed in 2007, 2008, the industry has underinvested in nickel, and the lead time to bring a new nickel mine into production is 7 to 10 years. So even if you make the decision today, you're not going to see those nickel units for 7 to 10 years. So a perfect storm is brewing. We believe in nickel, and it will be accelerated by the shift to 811. I'm not sure how much of battery capacity over the next 2 to 3 years is going to shift to the 811 chemistry. I know CATL has announced that they're accelerating their transition to 811, but there's some speculation in the industry that that's more talk than reality. 811 is still a challenging chemistry in terms of thermal instability. So I think the transition to the higher nickel chemistries will take maybe more time, at least for the industry, to shift than was suggested in the recent CATL announcement.
Yeah. Okay. Earlier in your career, you had a very big win in uranium. So I want to talk a bit about that. Back to that time, it was before the bull market ended in 2007. So what got you interested in uranium as an asset class back then?
Yeah, so look, that's sort of our investment modus operandi. We first tried to pick the metal that we think has a favorable supply-demand outlook. As we see with nickel today, back in 2005, it was uranium. And then we try to position ourselves in the metal. We try to minimize exploration risk, because exploration is a really tough casino in terms of probability of success. So we scour the globe for mispriced assets in whatever that metal is, as we're doing now with nickel. We did with uranium, and in the case of uranium, we found a very large deposit in Africa. And quite frankly, the success we had in uranium was simply getting the call on uranium price right. We never expected uranium to go from $10 to $140 a pound, so that was a big surprise on the upside. We knew it was going to go up, and we knew that any uranium exposure would be re-rated accordingly, but yeah, that one surprised on the upside. And we could see the same thing happen with nickel. Nickel, when the nickel shortages emerged in 06, 07, the nickel price went to $50,000 a ton.
Yes.
Today it's $12,000 a ton. And we believe, and that was before the advent of electric vehicles. So that was really just base load demand, mostly stainless steel. So now you're layering in a completely new source of demand that didn't exist before, that's over and above stainless steel, which is 75% of current nickel demand. And we think, absent a new sort of technology disruption in terms of producing class 1 nickel, that the same sort of dynamic could occur. So for example, we've positioned ourselves with nickel exposure. We've taken a position in a company called Giga Metals, which has the world's second largest undeveloped nickel sulfide deposit in British Columbia, and it has a market cap of $10 million. And our thesis is that when the nickel price rises, just because of the massive number of nickel units in the ground, that's going to get re-rated. It's the equivalent in our sort of mind being an undated call option on nickel, and we kind of like that massive leverage, limited downside with the upside leverage to the price of the underlying commodity.
So how does the current uranium market look to you today? Do you still follow this? Are you interested in that?
We follow it. Look, we love uranium because we had so much success with not only our main uranium play at the time, but then we subsequently, after we sold that company, we reloaded on uranium exposure, and it was one of those things where we just couldn't miss. So it's hard not to love something like that. However, as rational investors, we still cannot convince ourselves that there's a catalyst in the near-term horizon that's going to result in a re-rating of the uranium price. And so while we continue to look at projects, we don't see, and it's too hard to fight the tape. So if we don't have conviction that the uranium price is going to go up in a meaningful way, it's not worth owning a uranium asset. And our view simplistically is that everything's moving in the wrong direction for uranium. You have most of the world shutting their nuclear power plants down. The only new builds are largely China. And at the same time, you've got this sort of massive push and investment in renewables in the form of wind and solar, which frankly, in the US, for example, is actually more competitive, cost competitive than nuclear power.
Right.
And so with this sort of dynamic, and the world's not short uranium. The Kazakhs have shut in capacity, which can be brought back on in short order. Cameco has shut in capacity. So, well, a number of our friends remain uranium bulls, and we would love dearly to become one again. Our analysis doesn't allow us to do so.
Okay. As we begin to wrap up the show, Mike, can you give us a sense of what you'll be talking about at the conference this weekend?
Look, we've been really focused on, we think the advent of electric vehicles is maybe the most significant development for the mining and metals industry since perhaps the China inspired super cycle of the early 2000s, and it has significant implications for a range of metals that are used in battery fabrication, but also copper, which is used disproportionately in the manufacturing of electric vehicles, both the motor and the wiring. And so we think this thematic is just at the first inning, and it's going to be transformative for a range of metals. So there's more than enough there, we think, to continue to focus on it. So we've been early on the EV transition or revolution, and for the next 2 to 3 years, we think that's going to be the most interesting place to be in the metals industry.
Excellent. Okay, well, thank you very much for your time today, Mike.
No, it's a pleasure, and thank you, and look forward to next year's conference.
Excellent.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?